Welcome to the Deep Dive. Today, we're tackling a really interesting move in the market. Warren Buffett's Berkshire Hathaway significantly upping its stake in Constellation Brands. This was back in the first quarter of 2025.
Right.
Now, you probably know Constellation. They're the powerhouse behind Corona, Modelo, a whole bunch of other drinks. But the fascinating part is, well, their stock hasn't exactly been lighting things up lately.
Yeah, that's right. We're digging into this analysis piece. Buffett buys falling Constellation Brands. Why? And it really sets up the puzzle. I mean, here's a company whose stock took, what, a 14% hit this year?
Yeah, roughly.
And significantly underperforming the S&P 500 over the last 5 years. So the big question we're trying to answer today is, why is Buffett, the classic value guy, adding more to an investment that's facing these kinds of pressures?
And what does it tell us maybe about long-term thinking? About the real strength of some brands?
Yeah.
Okay, so let's get into the weeds a bit on Constellation's current situation. The analysis we're looking at, it paints a picture with, well, some good points, but definitely some clear headwinds too. As of mid-May 2025, their stock price was hovering around $195 a share. Some analysts were saying, okay, fairly priced, maybe even, a potential bargain.
Right.
But when you look at the recent performance and the future outlook, yeah, you can see why some folks might be a little hesitant.
Absolutely. And if we look at the financials, say for the fiscal year that just ended in February, market cap's sitting around $35 billion.
Okay.
Their forward PE, the price-to-earnings ratio, based on what they expect for fiscal 26 earnings per share, $12.75. It's about 15 times.
15x. Okay, so that's below the market average, isn't it? Suggests maybe some value there.
It does, yeah. It certainly highlights that potential undervaluation Buffett might be seeing. But it's also important to note, those expected earnings for 26, they're actually projected to decline slightly.
Ah, right. And that slight decline, the analysis connects that to the revised expectations for their beer revenue growth, doesn't it?
It does. They were initially shooting for like 7% to 9% annual growth. Pretty strong.
Yeah, ambitious.
But they've scaled that back quite a bit, actually, down to a 2% to 4% range for fiscal 27 and 28.
That's a big shift. And clearly that didn't sit too well with the market.
No, definitely not. But what's really interesting here, despite that slower growth forecast, is their ability to generate cash. It still looks pretty strong.
How so?
Well, they updated their guidance. They're projecting a cumulative free cash flow of around $6 billion for the period from fiscal 26 through 28.
It's being cumulative.
Yeah, and free cash flow, that's the cash left over after covering all the operating costs and capital spending.
All right, the money they actually have to work with.
Exactly. So when you put that $6 billion against their current $35 billion market cap, it works out to a free cash flow yield of about 5.6%. 5.6%. That does sound pretty attractive, especially for someone like Buffett looking long-term. That yield, it tells you how much cash you're getting relative to the stock price, right?
Precisely. It suggests there's still a real engine there generating cash, even if the top-line growth isn't what it used to be.
And let's not forget they also pay a dividend, yielding just over 2%. Pretty solid, stable return in that consumer staples space.
Stable.
Plus, they've got that big share buyback program going. $4 billion running until fiscal 2028.
Yeah, and think about what that means. A buyback reduces the number of shares out there, potentially making each one left more valuable. That $4 billion, that's almost 12% of their market cap. That's significant.
It really is. So while maybe the fast revenue growth is slowing, they're using other levers, financial tools, to boost shareholder value.
Exactly. And we should also mention their operational efficiency. They're expecting beer operating margins between 39% and 40%.
Oh, that's high.
It is. It signals real pricing power and pretty good cost management, even while they're dealing with those tariff issues. Yeah, the tariffs. Let's talk about that. That's another big challenge, right?
Yeah.
The 25% tariffs on aluminum and on Mexican imports.
Yes.
Given how much beer they make down in Mexico, that must be squeezing their profit margins.
Oh, it certainly is. And the companies factored these higher costs into their projections, their guidance through fiscal 28. The analysis we're using really emphasizes the tariffs, combined with that lowered growth outlook they announced in April 25. That was a key reason the stock price took such a sharp dive.
The market reacted pretty strongly to the potential hit on profits.
Understandably so.
Which, okay, brings us right back to the main question.
All right.
Why is Buffett, seeing all this, actually increasing Berkshire's stake?
Right.
The analysis points to a few key reasons, starting with what Buffett loves to call economic moats. Those sustainable competitive advantages.
Yeah, and it's interesting how these moats show up in what seems like a mature industry, alcoholic drinks. Constellation has this incredibly powerful brand portfolio. Corona Extra, Modelo Especial, Pacifico are mentioned.
Big names.
Huge. Plus the tequila, Casa Noble, Kim Crawford wines. These aren't just any brands. They've got established global distribution, a real premium image, and that gives them pricing power.
Right. People seem willing to pay a bit more for those specific beers or drinks. And that gross margin figure you mentioned earlier, nearly 51%.
Almost 51%.
Yeah. I mean, in that sector, that really says something about brand loyalty and pricing leverage. It's exceptionally high.
It is. And this fits perfectly with Buffett's classic approach. Be greedy when others are fearful. The market sentiment right now, the analysis suggests, is a bit skeptical about the whole alcohol sector.
Why is that?
Well, you've got these trends, right? Younger people maybe drinking less alcohol overall, the rise of healthier alternatives, seltzers, that kind of thing, and just general declines in per capita drinking in places like the US and Europe.
So the market's kind of nervous, focused on decline, and Buffett sees an opportunity. The classic contrarian move.
Exactly that. He's famous for playing the long game. Decades, not quarters. So even if people are drinking slightly less per person, the total global market is still enormous.
Good point.
And within that huge market, premium brands like Constellations often gain share. It's that whole drink less but drink better idea. People might choose one really good beer instead of, several cheaper ones.
That makes a lot of sense. Focus on that premium slice. Okay, but let's circle back to those headwinds for a sec, especially the tariffs. Does Buffett likely see this as just, like, temporary noise? Or is it a bigger structural problem?
That's a really critical question. The analysis highlights the geopolitical uncertainty, particularly around a potential future Trump presidency as a big concern. Import tariffs on Mexican goods. That's a direct threat to Constellation's profits because so much production is in Mexico. Plus, the 25% aluminum tariff adds to packaging costs.
Okay.
Now, there was a partial delay recently on some Mexico tariffs, which gave them a bit of breathing room, but the basic uncertainty about trade policy, that's still there.
So it's a real risk to their bottom line. Why would Buffett, who usually avoids uncertainty, look past that? Does he think it's just political posturing? Maybe? Not a permanent shift.
Well, this is where his track record comes in, right? He's often shown he's willing to look past short-term noise, macroeconomic worries, if he really believes in the company's core strengths, its competitive advantages.
And moats again.
Exactly. The analysis suggests he probably sees these tariffs as either temporary or at least something a company with Constellation's brand power and pricing ability can manage over time. Maybe they absorb some cost, maybe they pass a little bit on carefully.
Okay, so the strong brands offers some protection against those storms. Now, the analysis also flags Constellation's capital allocation strategy as a big plus for Buffett. Why is that so important?
Right, we touched on the free cash flow earlier. Targeting $6 to $8 billion over the next 3 years, that's a lot of cash relative to their size. Like the analysis points out, compared to their $35 billion market cap, that could mean a cumulative FCF yield somewhere between 17% and 23%. That's a huge potential return just from the cash they generate.
And they're not just hoarding it, they're sending it back to shareholders, buybacks and dividends.
Precisely. That buyback program, nearly 12% of the company, that directly boosts future earnings per share. And the dividend, okay, maybe not the highest yield out there, but it's stable, it's growing. That's the kind of consistency Buffett loves.
It shows discipline from management, right? Focusing on shareholder value even if growth slows down.
Exactly. A commitment to long-term value.
This reminds me of some of Buffett's other consumer goods plays. The analysis draws this comparison between Coca-Cola and Kraft Heinz. Why is that relevant here for Constellation?
Yeah, that's a really key point for understanding the potential thesis. Coca-Cola, obviously, a huge long-term win for Berkshire. Amazing brand, dividend machine, sees candies, smaller scale, but super profitable niche brand. But then you have Kraft Heinz. Big investment, big write-down later. Showed what happens when maybe the brands lose steam or the company doesn't innovate, doesn't keep up with changing tastes.
So the big croaking is, which path does Constellation look like it's on in Buffett's eyes? Is it more like the enduring Coke, or does it risk becoming another Kraft Heinz?
The analysis strongly suggests, and Buffett likely agrees, that Constellation is much closer to the Coke model. Why? Well, they've got real pricing power in that premium segment. They have global distribution, which gives them scale advantages.
Hmm.
And importantly, they have the ability to launch new drinks, maybe non-beer options, using that same distribution network if consumer tastes keep shifting. They aren't just stuck with traditional beer.
Yeah, makes sense. They've got a strong foundation to build on, to adapt.
Oh.
Okay, so let's pull this all together. Based on the numbers, the analysis, what's the core rationale here for Berkshire?
It really looks like classic value investing. You've got a company with what seems like an attractive valuation. That PE around 15x looks good compared to the overall market. You see strong, consistent cash generation, that 5.6% FCF yield, like the disciplined capital return dividends, buybacks. And crucially, you believe in the long-term resilience and global appeal of those core brands.
So the market is maybe getting caught up in the lower growth numbers, the tariff worries, the changing drink trends, and the stock price reflects that anxiety.
Right.
But Buffett's stepping back, looking past the immediate bumps, and seeing a fundamentally solid business that he thinks is selling for less than it's worth.
Precisely. The analysis even throws out a number suggesting Berkshire might see a potential return of, say, 30% to 50% in a few years, even without huge revenue growth. It just relies on the market eventually recognizing that underlying strength.
It really makes you think of that famous Buffett quote, doesn't it? In the short run, the market is a voting machine. In the long run, it is a weighing machine.
Exactly.
He clearly thinks Constellation Brands weighs a lot more than the current votes suggest.
Absolutely. And this whole deep dive into Berkshire buying more Constellation, it's just a great case study in value investing principles, isn't it?
It really is.
Despite all the headwinds, the industry worries, the tariffs, Buffett's move seems like a clear bet on those brands. The value, the cash flow, all looked at through that long-term lens.
And the real aha moment here, maybe for you listening, is seeing how this plays out. It's about finding quality companies at reasonable prices,
Yeah.
even when they're facing temporary issues or bad sentiment.
Yeah.
It's a good reminder to try and look past the short-term market noise sometimes.
Definitely. And it makes you wonder, doesn't it? Think about other companies out there right now. Maybe their stocks have taken a hit. If you apply this Buffett logic, what other businesses with strong fundamentals might be undervalued because of temporary fears? Are there industries or companies you're maybe overlooking right now because of short-term headlines that could actually be really interesting long-term opportunities?
Something definitely worth mulling over on your own.